Good morning. Once again, I have the privilege and honor to be talking to Sebastian Rivera, Senior Loan Officer of Intercoastal Mortgage. Without further ado, Sebastian, good morning.
Good morning, Adrian. How are you?
I am great. So let's get into the meat of things. I know we talked about certain things that we wanted to cover today. I'm just going to start off just to get that elephant out of the room. Let's talk a little bit about what you envision, what your firm envisions as where the Fed might go towards the end of this year.
Well, as you know, with the Fed increasing Fed fund rates, what they're trying to do is lower inflation. With lower inflation is going to come lower interest rates. And what I think they're going to be doing right now is they're likely going to do one additional hike before they pause and figure out what's happening. We are seeing inflation start to come down, 6.4 down to 6. Right now on April 10th, or April 12th, we're going to get the next reading. And then May 10th is the one that most mortgage bankers are looking forward to. Because the average on inflation over the last 12 months will drop since April 2022 was the last large hike. So I think that there's going to be one additional hike, then they're going to pause, figure out what's going on, look at the data, and reevaluate.
So I'm going to streamline then directly into let's talk about rates. Where are we right now, and what do you foresee for the future?
They're coming down. Yay! It's great news.
Yay!
As inflation ticks down, rates are coming down. I'm a little bit skittish going into April 12th, what's going to happen. I think we're going to see a slight decrease on rates, but nothing large. Then coming May 10th, you're going to see a nice tick downward, which is going to push mortgage rates down. And every month forward, it's going to continue to drop. CNN had a great article about 5.25 rates by the end of the year. I think we're going to see them sooner, probably by September.
Great. I do caution my clients, and I hope that you are in line with me. To me, the new normal is going to be around five, at least from here to the end of the year, depending, of course, on the instrument. But as a talking point out there, don't have great expectations of being back in the low twos, like or in the high twos, like we were in the past.
No.
Am I correct in assuming that?
Yes, it's going to take a long time for the Fed to get back to their target range of 2%, 2.2% inflation. It's just going to take time, a lot of effort. This is not happening this year. It won't happen next year, and it won't happen the following. They're probably going to get down to the 4-ish range by next year, which is great
Hmm.
news for us. It's
Right.
just going to take time. So
So tell me, let me segue into different instruments. What is the most popular instrument that you're seeing today when it comes to
and
financing real estate?
mortgage products, believe it
Hmm.
or not, it's still the 30-year fixed. ARMs
Right.
are popular if you have the 20% or more to put down. Many of the ARMs from portfolio lenders have disappeared from the market because the servicing value is close to zero. Everybody originating a loan right now knows that they're going to be paid off in the next 12 months anyways, 12 to
Right.
18 months. So there's really no servicing value in it. That's why we saw so many ARMs disappear. There still are some ARMs out there, but they only start to show their strength when it's 20% or more down payments. So 30-year fix is still popular. We're in the mid to low sixes, and some of the 30-year fixed high fives. With the government products, mid fives with no points. So we're getting there.
Okay. Yeah, I was going to ask you because I have seen a drop in requests for arms. I just wanted to have a little more insight on what that was. And of course, we're going back to the 30-year fixed, which for people like me, arms was a little bit bringing back of the past into a generation that was not accustomed to that. So, and I have seen a drop in the possibility of garnering that kind of instrument for my clients.
Mm-hmm.
Okay, so let's move on to, that one of my key markets is downsizers. So just to define them a little bit, they've probably been living in their properties 25, 30 years, or sometimes even less than that. They have good equity, and they decide, I want to sell my property and I want to buy something new. What would be an instrument suggestion that you would make to a downsizer?
Patience. Patience is key. Patience is key. The biggest challenge that I see with the downsizer clients I have found is finding the right property. It's not the ability to be able to do so. It's the lack of inventory and them searching for an extended period of time just because there's not enough inventory to go around and choose from. Most of my downsizers are highly qualified, high credit scores, tons of equity, if not fully paid off homes. And they say, you know what, we just want a small mortgage on the next one. And I have quite a few clients that are still looking for
Right.
that right house.
What is one of the advantages, since you just touched upon that, of financing, even though it's a small portion of financing the next property? What is the advantage to the home buyer?
Tax deductions. Typically, my downsizers do not need to finance. They don't have to. They could easily pay cash for it. But either from financial advisors, from accountants, they said, you know what, let's finance a portion. That finance portion, we're going to invest it in the market. We can get you higher yields than 6.5%, for example. So yeah, they get the tax deduction and get to invest those funds in other assets.
Perfect. When it comes to the overall greater Washington, D.C. area that you market, what have you been seeing? I sort of caution my clients in not considering this depreciation time. I do think that compared to last year and the year before, where we had these crazy 30 offers and things like that, I think that instead of a price decrease, I feel that properties are going on the market at fair market value. So it wasn't just slap a coat of paint and decide on 30% over fair market value, just put it on the market and let's get 10 offers. Am I correct in assuming that?
Yes, what I'm seeing is a deceleration. Right now, I would say properties under 800,000 still have multiple offers on them. You'll see 4 or 5 offers on one single property. As you see rates continue to decrease, this same $800,000 property is probably going to have 7 or 8 offers, which is going to drive the price higher. Properties that are over 1.2, 1.5 have less offers, but there's still healthy demand for them.
Well, I think that part of the seller's market situation is primarily due to the lack of inventory that we see in this area. Uh, I
100%.
I think that on the other hand, I feel that in the $800,000 and lower value properties, we might have the opportunity of stimulating certain sellers to get into the market, because we need that inventory. I have buyers I haven't been able to find properties for. And I think that prevails within this area. So I see a little light at the end of the tunnel, that we might convince certain sellers to put their properties on the market because we need that inventory. And there's always a way of finding options for downsizers, especially on where to go. I have a harder time with the family that they got married, they have a kid, and they're upsizing. That to me is tougher. Downsizers, you can always decide on renting a space for a while in the state that they want to move to or the section of the city that they want to move to, and take that buying process at a slower pace, where upsizers are literally in need of the space, and that makes it a lot more complicated and a lot more competition in that segment of the market.
Yep.
Anyway, any other additional comment that you have for me regarding mortgages?
Lower rates coming ahead. There's going to be new products coming out. There's some interesting things in the pipeline. Believe it or not, we're starting to see some really interesting loans regarding, for example, stated income loans, much higher rates, of course. Other loans that don't look at income at all, that just look at the cash flow value for investors. So there's some really cool products coming down the line, many more to be released. This is going to be an exciting year for the mortgage industry. It's been tough the last few months, but lots coming down the line.
Yeah, I'm more particularly interested in, maybe we can cover that in another segment. What is available for real estate investors? What's coming down the pipeline that might make it a lot more attractive to them. At this stage of the game is just picking up properties of a certain value, that have a low cost of refurbishing and then putting it back on the market. And you can take advantage of the fact that we're in a seller's market, so it makes it attractive to them. But it would be interesting to know what other instruments are coming on board that would be targeted to this segment.
Of course.
Okay, very well. Well, as usual, it's been a pleasure. speaking with you, Sebastian, and I hope we can do this again soon. And let's just keep our fingers crossed that the Fed does what it has to do,
I'm
and
sure
that
they will.
we can definitely move forward in a positive way. I feel that it is my sense, contrary to the commercial side of the business, that real estate, homes are really at this stage of the game holding solid, and that the business is still good. Buying and selling is still a good option.
If I had to add one more thing to this conversation, it would be don't trust the media. The media is fantastic at disinformation. I was watching CNN the other day, and home prices are plummeting across the United States, and I'm watching that on one screen, while on the other, I have my clients freaking out. Hey, we need 2 more approval letters because we're escalating 20,000 above asking. It's maybe in some parts of the country, but welcome to Washington D.C. It's a
I
nice little
agree.
bubble here.
You have to be picky. I was listening, which, by the way, I would recommend if you didn't see it this morning, Barry Stenlick on from Starwood Capital on Squawk Box this morning, and he is in line with what you just said, and he's also in line of what's happening in the housing market, not in the commercial aspect.
Correct.
He had very interesting stats on rents. He had very interesting stats on how the housing market is holding solid, and to me, that's the message that we should all be putting forward to our clients, at least in this market. I
Mm-hmm.
can't talk about everywhere else, but in our market, we still, as I said, have lack of inventory. Business is booming. There's opportunities coming on the market, and hopefully we'll have an increase in inventory to capture properties for potential buyers that are out there because they're out there all year.
Mm-hmm.
Okay, very well. Sebastian, as usual, thank you very much,
Thank
and
you
I'll
too.
see you soon.
I'll see you soon.